I hope I'm adding on to where I left off in Interbank Liabilities. I wasn't very far. I was talking about the coverage. Now I'm jumping into requirements. This is Reg F from the Reference Guide to Regulatory Compliance. Requirements, this is under federal regulation Title 12 of the Code of Federal Regulations, Chapter 206.3. This is one that the Federal Reserve maintains. Banks must establish and maintain written policies and procedures to prevent excessive exposure to correspondent banks. Standards for policies and procedures. They must take into account credit, liquidity, and operational risks in selecting and maintaining correspondent relationships. These policies and procedures must require periodic reviews of the financial condition of correspondents to whom there is a significant exposure. Reviews must include consideration of the capital level, earnings, non-accrual loans, and past due loans of the correspondent bank. Banks may rely on a rating agency for financial control assessment with board approval, and the board of directors must approve these policies annually. Establishing internal limits. The bank must establish internal limits or develop another equally reliable system in the bank's policy to control exposure where there is a significant risk. Payments will not be made in full or on time. That's the risk, that payments won't be made in full or on time. The standards for policies and procedures require that exposure to correspondence is monitored to make sure it does not exceed the bank's internal limits. The monitoring may be retroactive, which is a good flexibility to have. And the level of monitoring depends on volatility of exposure, the extent to which it approaches the established limits, and the financial condition of the correspondent. Procedures must be established to address excesses over the bank's internal limits. B. Responsibilities of the financial institution are that the bank must prudently limit credit exposure to correspondents, and this can be done by a limit on intraday credit exposure, which is not to be more than 25% of the bank's total capital unless the correspondent is adequately capitalized. If the correspondent fails to meet adequately capitalized standards, the bank must reduce its exposure to no more than 25% of capital within 120 days. And further, to limit an intraday credit exposure, an institution's total capital includes the total of the bank's Tier 1 and Tier 2 capital. In order to prudently limit credit exposure to correspondents, there is a calculation of credit exposure. Credit exposure being credit exposure to a correspondent consists of the bank's assets and off-balance sheet items that are subject to capital requirements of the capital adequacy guidelines of the bank's primary regulator, and that involve claims on the correspondent or capital instruments issued by the correspondent. Exposure includes credit exposure to the correspondent of any subsidiary required to be consolidated within the bank on the report of condition. Transactions under valid and enforceable netting contracts will be netted in the exposure calculation. The exceptions to exposures to correspondents calculation, that is, of credit exposure is 1. Exposure from transaction settlements, intraday exposures, or agency transactions where the loss will be passed to a principal. Other exceptions to transactions that are secured by government securities or readily marketable collateral, which is financial instruments or bullion that can be sold with reasonable promptness at fair market value, at auction, or at a daily bid and ask market. Third, exception to the calculation of credit exposure is proceeds of deposits that have not been made available for withdrawal, and quality assets. These are assets on which the correspondent is secondarily liable or on which there is a creditworthy obligor available. Quality assets that are exceptions to the calculation of credit exposure are 1. Assets that are not in a non-accrual status, 2. Assets that are not past due more than 30 days, and 3. Assets whose terms have not been renegotiated or compromised because of the deteriorating financial condition of the obligor. An asset cannot be considered to be a quality asset. However, if other loans to the primary obligor have been classified in the most recent regulatory examination report, oh my goodness, I just scrolled way too far. What report? Boy. Report of condition. And transactions under valid and enforceable netting contracts will be netted in the exposure calculation. Nope, that was wrong. Because I'm in the exception section talking about quality assets. Okay. That have been classified in the most recent regulatory examination report of the bank or an affiliate. Those are assets that cannot be considered quality assets if those loans were classified as loss, I would assume, in the most recent regulatory exam of the bank or the affiliate. Quality assets, however, can include the following. 1. Loans to third parties secured by stock or debt obligations of the correspondent. 2. Loans to third parties purchased from the correspondent with recourse. 3. Loans to third parties backed by letters of credit issued by the correspondent. And 4th, obligations of the correspondent backed by letters of credit from a creditworthy third party. For 1 year after consummation, exposure resulting from the merger or an acquisition of the bank is an exception to the calculation, as well as exposure that is covered by the Federal Deposit Insurance. Furthermore, as I continue under the section of limiting exposure to correspondence, you have a frequency of monitoring capital levels. Banks must obtain enough information at least quarterly to monitor the capital levels of their correspondents. Banks may rely on information they reasonably believe to be accurate. And the capital levels such that need to be monitored of the correspondent. For U.S. institutions, the capital ratio must be included in accordance with the capital adequacy guidelines of its primary federal regulatory agency. Foreign banks' capital ratio, however, must be calculated in accordance with the guidelines of the supervisory agency of the country in which the bank has chartered. If its country has adopted the Basel Capital Accord. If the country has not adopted the Basel Capital Accord, the capital ratio of the bank will be calculated according to the provisions of the Basel Capital Accord. And to be adequately capitalized, a bank must have a total risk-based capital ratio of 8% or greater, a Tier 1 risk-based capital ratio of 4% or greater, and except for foreign banks, leverage ratio of 4% or greater. The penalties is the last section. Under the FDIC Insurance Act, failure to comply can cause a termination of FDIC deposit insurance, and there are FIRA penalties, which are your usual $7,500 per day for violations of law and reg, or $37,500 per day if there's unsafe or unsound practices that are recklessly engaged in, or a pattern of misconduct that causes more than a minimal loss to the bank or any pecuniary gain to the parties involved. And lastly, $1.425 million per day against persons who knowingly commit a violation and knowingly or recklessly cause a substantial loss to the bank or substantial benefit to the party that is causing a substantial loss to the bank. And that's it for interbank liabilities, the end.